Hi there, and welcome to another episode of The People of Private Capital. Today, I speak with Hugh Elrington from Barwood Capital, a capital allocator in the UK market focused on industrial, residential, and a range of other sub-asset classes in the commercial real estate sector. It is a fairly far-reaching conversation with Hugh. We talk about his background, what brought him through CBRE right into Barwood. We cover some of the conditions that exist in the UK market, some of the challenges, and of course, we take a look at some of the emerging opportunities in the broader UK market. So sit back, relax, and enjoy this episode of The People of Private Capital. Well, Hugh, it's great to have you on the podcast here. As I mentioned in the introduction there, a tremendous amount happening at Barwood. Welcome to the People of Private Capital podcast.
Thank you, Freddie, and thank you for having me as your guest and to be able to talk about the UK real estate market and what we do in that sector at Barwood.
Yeah, absolutely. Absolutely. Very keen to get into that. As we do on all of these podcast episodes, Hugh, we like to give the audience some perspective on your background and kind of what brought you to where you are now at Barwood. So if you wouldn't mind just giving us a little pre-seed history of Hugh from perhaps your, college days on to, how did you arrive here?
Yeah,
Focused on, as you say, the real estate sector in the UK at Barwood.
no, absolutely, and thank you, Freddie. I, in fact, did a degree in real estate at university, having decided that it was a sector that interested me after having left school.
Hmm.
Partly my interest in buildings, and probably more importantly, learned quite quickly that a lot of what we do is all about network and who you know. And I love meeting new people. I love new challenges, and I felt real estate um, was able to offer me that.
Hmm.
I started my career in the industry at the very end of the 1980s, early 90, working, in fact, as a city leasing office agent for Richard Ellis, as it was called
Right.
back then. Um, After which I joined a small general practice surveying firm in the West End of London, where we basically did a bit of everything from investment work to leasing work to valuation work, arbitration work, etc., etc., which was an incredibly good grounding for someone when you're doing your RICS CPD, where you have
Right.
to write thesis on what you've learned, and it gave me a very amazing cross sector of the real estate industry, and that's where I qualified with my letters.
Right.
Um, Following which, I then joined a company called St Quintin, where I joined what we call the in-house investment team, which was looking after in-house clients of the firm. So the people like Royal Bank of Scotland and Royal Sun Alliance, and doing all their buying and selling for them within the team that I was in, and absolutely loved that part of the industry. And back in those days, in the early mid-90s, it was all about, as I said, who you know, your network, being able to find things off market,
Yeah.
and really fascinating part of my career.
That was they were pretty heady days. I was in London. I moved to London in '89 and was there through the '90s and actually up into the early 2000s before I moved to the States. But very heady days in London in the mid '90s. I mean,
Very long
incredibly.
lunches, lots of bars, and as
That's
a
right.
youngster growing up,
Yeah.
it was the perfect environment. And in fact, I remember anecdotally being taken aside by my boss at the time, saying I wasn't spending enough on expenses, and
Yeah.
therefore
Yeah.
I couldn't be generating enough
You
deals.
need to
Uh,
hit those Conran restaurants and get out there and
Absolutely, absolutely.
vivend them.
So
And yeah,
yeah, yeah,
exactly.
no,
Yeah.
perfect.
Yeah.
So and very much my focus was across all the asset class sectors, from retail to industrial to offices. So again, great
Right.
grounding, and really just focus, as I said, on those two clients,
Yeah.
which gave me also a huge insight to how investors think and how you have to report to them. So you were more than just an agent, a brokering agent. You were their advisor,
Yeah. Yeah.
and I really enjoyed that part of the business. We then got bought by a very large American group who already owned Richard Ellis, called Insignia, out of New
Right.
York.
Yeah.
And in expanding Richard Ellis, they acquired St. Quintin, and we got merged into a bigger entity. So I sort of went back to where I'd started on the office leasing side. So I knew quite a few people already at Richard Ellis, and so it made the transition
Yeah.
very easy. And I have to say, it was, looking back on that, that was 1998, 99, and having been involved in a few mergers since and watched other firms merge, I think it was one of the best that ever happened. And in fact, whatever it is now, nearly 28 years on, 7 years on, there are still a lot of people at CBRE who were at St. Quintin. So
Yeah.
it shows you how well it worked.
Yeah. If you've witnessed those that haven't, you kind of really do appreciate it's a very tough to make
It's
those merges
very
work.
hard, and
Yeah.
particularly on the people side,
Yeah.
because our industry is all about the people.
Yeah.
And so a lot of them don't get it right. Whilst it looks like an interesting merger, the people don't merge, and it
Falls
collapses.
apart. Yeah. Yeah.
So that happened. I then continued to do regional investment throughout the UK, and then the game changer happened for me. I actually come from an army background. My father was in the military,
Right.
traveling all over the world, particularly Europe. And
Yeah.
actually, I grew up for a large part of my early life in France. So I
Right.
speak French fluently.
Right.
And Insignia, in their expanding their global property network, bought a business in Paris that had a network across the whole of France, 48 offices
Right.
across France. And my CEO back in London discovered I spoke French. I was doing investments, so I helped with the due diligence of the acquisition of this French business. And in
Right.
meeting the French team, they said, "Oh, we must have Hugh here. He speaks our language, he
Yeah.
understands us." And so I got offered the opportunity to go and spend 2 years in Paris,
Right.
um,
Very nice.
with what was called at that point Insignia Bordeaux,
Mm-hmm.
and really to sit in the investment team there and really educate them on the buy side of the investment world. To date in Europe, it had been all about selling investments,
Yeah.
not ever buying on
Right.
behalf of clients. Um, and I moved there with my wife and two very young children. And
Mm-hmm.
in fact, we had our third son was born in Paris.
Right.
We went originally for 2 years. We stayed nearly 5. And actually, I then got involved in my second sort of merger when um, Richard Ellis UK and Richard Ellis Europe became one, which was Hillier Parker, and CBRE basically became the big, as we know it
Right.
today, the big
Yeah.
green machine.
Mm-hmm.
And so I stayed to help the transition of that in France. Absolutely loved my time there. My dress book exploded because I
Yeah.
became a big fish, a big fish in a small pond.
Mm-hmm.
And a lot of clients of CBREs from around the globe wanted to buy in the French market, and so I got to know a lot of people outside of the UK and Europe.
Yeah.
Um, and I think that was the trigger for me, thinking about the future. Came back from my nearly 5 years in France, and in April 2006, I left CBRE and set up my own investment business, asset management business, which was to basically, in a nutshell, take UK equity into France and Germany.
Right. Okay.
And three of us created this business together. And in fact, I'm managed to persuade my ex-CEO by then of CBRE to become our non-exec chairman of the
Right.
new business. And we started buying multi-let industrial in France and office and retail in Germany, and had a very, very successful first year, and then got approached by an Australian group out of Melbourne who wanted to create a pan-European platform,
Right.
who said, "Can we swallow you up? We'll provide you with 300 million of equity to go and invest on our behalf, and grow your platform, which I
Right.
thought was fantastic.
Great. Yeah.
And sadly, as we all know, the GFC happened.
Timing.
Timing, timing, as we all know in real estate, is everything.
Yeah. Yeah.
And whilst we'd had a successful 18 months and then thought we were going to do something absolutely great, the GFC happened and everything collapsed. And they
Yep.
were a classic Australian open-ended vehicle, had
Right.
huge run on redemptions, and it was the end of them. And
Yeah.
everything outside of Australia had to close. And
Right.
I put the keys back through the letterbox in Christmas 2008, but
Right.
have no regrets. It was the most amazing thing to set up and run your own business, and nearly, a whisker from
Yeah.
it being something fantastic.
Yeah.
But it gave me a bug.
Hmm.
By then, obviously, I had 3 children in private education. Salary was important,
Yeah.
and
Different motivations. Yeah.
correct. And I landed a role at what was then called Rockspring,
Hmm.
which was a pan-European fund management business, running both closed-ended and open-ended vehicles,
Right.
um, both in the UK and across Europe, with institutional investors from all around the globe. It was an ex-buyout from, which will mean something to you guys, from Pricoa.
Right. Yep.
Um, and I joined them in April 2009 and spent 9 years with them running the UK side, which was a mixture of value add funds, and some open-ended vehicles on behalf of pension funds,
Hmm.
basically doing all the buying and selling for those vehicles all
Right.
over the UK. Um, but equally at the same time got involved with the National Pension Service of South Korea, who was one of our investors in one of our vehicles,
Right.
and wanted to go direct into real estate in both London and Paris. And because of my previous experience, I was the best.
Perfect match. Yeah.
And so I ended up buying their first ever assets in central London, one in the city and one in the West End. And then a little later on, a big shopping centre just north of Paris.
Right.
Um, and I became an equity partner in Rockspring, stayed with them for nearly for 9 years. And the opportunity arose to leave when we, as the partnership, decided to sell Rockspring to what is now Patrizia, which I'm sure
Yes.
you've
Yep.
heard of. And I decided that I wanted another go at being in charge of my own destiny and helping grow a business. Done what I'd done at Rockspring. They were selling to Patrizia. So as part of the completion process, I resigned,
Right.
and um, saw and partly because at the same time I'd seen this great opportunity with Barwood, which was a
Yep.
very well-known name in the UK market. And
Yep.
so I joined Barwood as head of property in April 2018,
Yep.
which at the time was being run by a lovely lady called Joanna Greenslade. Um, and she was looking for someone with more, and she's from an accountancy background, had done a
Right.
fantastic, had founded the business, Barwood Capital, as it was called,
Hmm.
and was looking for someone from a real estate side to really come in and help her run it and take over from her. And
Yeah.
in February 2019, I became the managing director of Barwood.
Right.
We've
Right.
been there to today and continuing. So
Yeah.
that's sort of my. So I'm quite different from the standard UK surveyor in the sense that I've done 5 years of my life in continental Europe. I've bought in Spain, sold in Italy, Germany, France,
Yeah.
even Croatia,
Right.
and I have a global address book.
Just a quick interlude. I'm Freddie Roberts, CEO and founder at Asset Class. And at Asset Class, we provide software solutions for the front, middle, and back office of firms like yours in the private equity, venture capital, commercial real estate, and broader private capital markets. So check us out at assetclass.com. We'd love to talk. Now, on with the episode. Yeah. And
So
operating
hopefully,
across a very broad spectrum of I guess, sub-asset classes within that.
yeah,
So in let's say in the 2000s, prior to joining Barwood, where was the majority of your, let's say, on the acquisition, on the buy side, what types of investments were you?
To be honest, so the main acquisitions were for two closed-ended funds, one which
Mhm.
followed the other called UK Value.
Yep.
As its name, sort of core plus value add
Yep.
opportunities. We covered all three main sectors of industrial, office, and retail.
Right.
Um, it was a very fascinating time because obviously it was off the back of the financial crisis, 2009 onwards. You were still, to a degree, catching a falling knife, and it was a question
Yeah.
of when did you catch that falling knife. But it created great buying opportunity. And by mid '09, we'd raised 300 million for UK Value One,
Yeah.
and so out buying for that, and that was a mixture of asset management plays, and a lot of that was through the shopping centres that we acquired, through to out and out development in both the industrial and office sector, and um, all over the UK, including central London. So we were
Yeah.
doing some office repositioning plays in the city and the South Bank, through to spec industrial development in the Midlands.
Right.
So a whole range.
Yeah.
And then we closed that, and then launched at the end of the investment period, launched UK Value Two. And by the time I left Rockspring, we were starting to disinvest from UK Value Two.
Yeah. Good
So yeah,
vintage, I would
a
have
real
thought,
real range.
timing wise, to, I guess, opportunistically take advantage of what was happening.
Correct,
Yeah.
correct, correct.
Yeah. And as is the nature of these things, the most challenging times kind of teach you the most as well. So, what lessons would you have taken away from, let's say, that period? Obviously, pretty
Stock
tumultuous.
selection.
All right, what's
Sorry
that?
to interrupt. Stock selection
Stock selection, right?
is just key, and if I'm honest, we probably, with hindsight, had too great a weighting to UK shopping centres,
Right,
which underperformed when compared to the office and the industrial market
right.
in particular at the time.
Yeah.
And so I learned very quickly about A, stock selection, and B, weighting in when
Hmm.
you're composing a portfolio in a fund.
Yeah.
And
Yeah.
that was probably my biggest lesson
Yeah.
during that time.
I'm assuming. I mean, it influences. Certainly, I've spoken to a number of let's say your contemporaries in similar industries across different geographies, but the message is pretty much the same in insofar as it does inform, I think, in a positive way, your healthy skepticism when evaluating potential deals moving forward. Preparing for what might go wrong versus,
I
yeah.
Absolutely, but also what it does also tell you is there are certain sectors where you need specialists,
Hmm.
and if you don't have in-house specialists, particularly where it's very heavy asset management, very
Right.
intense, and shopping centres are probably the peak of that.
Yeah.
And unless you have absolute dedicated specialists, it's not a sector. So Barwood, for example, will not go into shopping centres because
Yeah.
even if we think there might be an attractive opportunity, we're not specialists. We haven't got that in-house
Yeah.
specialist knowledge in that sector.
Yeah.
So
Well,
again, that's
that's
very important.
yeah. Well, that's a good segue, Hugh, into Barwood. Um, so 2018, you joined as head of property, as you mentioned, very quickly, I guess within a year, managing director.
Yeah.
First of all, what appealed to you about the Barwood proposition at that time? And then we can perhaps talk more about their interests,
Yeah,
or your
yeah,
Barwood's interests. Yeah.
absolutely. I mean, Barwood, as I think I said earlier, was an extremely well-known name in the
Hmm.
UK market, particularly the regions outside of central London.
Yeah.
I'd watched it over the years grow quite substantially. Several of my friends that I knew in the real estate sector had gone and worked there and done extremely well in helping grow the business. I loved the fact that it was owner managed.
Right.
So we have no outside shareholders. We own the business ourselves.
Yeah.
And I suppose it's because I'd had the taste when I had my own business back in 2006 to the GFC.
Yeah.
I thought I want another challenge to go into a business and help continue to grow it with some ownership
Right.
and be in charge of my destiny again. Whilst I loved Rockspring and had the most amazing 9 years there, and would have continued if it had continued as it was, but I get why some of the equity partners wanted to move on because they wanted to retire. I didn't want to then go into a big corporate like Patrizia, nothing against them, just didn't want
Yeah.
to be back into that big corporate world. And so it was a great opportunity to go and join Barwood. I mean, Barwood, and what I loved also about Barwood started back in the mid 90s, 96. It was a buyout from a well-known estate agency in the Midlands, and really started life as a developer.
Right.
Really going from deal by deal basis, finding the opportunity, and then finding the equity to back it, create it.
Exclusively residential at that time
No,
too, or
it was.
no?
I would say it was across three sectors, but
Right.
predominantly industrial and residential.
Yeah.
But did the
Okay.
odd office.
Yeah.
But it was more about finding the right opportunity, demonstrating to the capital how it could really drive and create value, all
Hmm.
total return driven, wasn't about income. And it was create the best in class asset, which would allow you to hopefully get the best tenant for that location at the best rent for that location, and give you as liquid an asset as you can for exit,
Yeah.
and then trade it on. And they were extremely successful from, as I say, from that mid late 90s through to the GFC.
Hmm.
But living, some might describe hand to mouth, because you're obviously finding the deal and finding the equity to back the deal, or sometimes having the equity, knowing what the equity wants and finding
Right.
the deal that suits. And it was during the GFC they realised that it made total sense to create what is Barwood Capital as part
Right.
of the Barwood Group or umbrella, as an FCA regulated entity, to go and raise capital first and foremost, and then go and back the schemes that Barwood Developments, as it was. So what happened was you had Barwood, the umbrella name, and under
Right.
that you had Barwood Developments, Barwood Land, Barwood Homes, and then they created Barwood Capital.
Right.
Barwood
Okay.
Capital was there, raise the money,
Yep.
and then invest in the three different groups in opportunities they found. And that was very successful. They launched their first vehicle in 2009, mainly raising money from friends and family.
Yep.
And then by 2012, they got cornerstoned by British Airways Pension Fund,
Right.
which was really the making of them, of Barwood Capital in particular, because it became their biggest raise. And then in 2013, Barwood Developments got poached by Delancey to become DB Symmetry, which is now Tritax
Right.
Symmetry. So now a REIT. So and
Yeah.
again that evolved, and at that moment the group sort of split, and you had Barwood Capital Land and Homes, and Barwood Developments went off with Delancey, and a chunk of the team went that way, and the rest stayed here. And
Right.
then in 2017, just before I joined, Barwood Land and Barwood Homes was sold to a private pan-European equity house.
Right.
And so since the minute I joined, you just had Barwood Capital,
Yeah. Okay.
and we've carried on raising vehicles ever since.
Yep.
So when I joined in 2018, we were then on our third growth fund, which is
Right.
a value add play,
Yep.
like 1 and 2, 5-year closed-ended vehicle. At that point, Growth Fund 3 was anchored by British Airways Pension Fund and then Merseyside Pension Fund, with the rest of the equity made up from our private high net worth base and family
Yep.
offices.
Right.
Um, and So I joined then, and since then we've launched and invested, and now disinvesting from Growth Fund 4.
Yep.
And we launched a few years ago Growth Fund 5, which we've fully invested as of the end of July.
Right.
And we'll be looking to launch number 6 very shortly.
Yeah.
Um,
Yeah. Very active.
yeah, so very, very active. At the same time, we also launched a multi-let industrial vehicle
Right.
back in 2021, which we've built so far up to about 65 million of AUM, and
Yeah.
are continuing to build that as we go. That'll be a longer 7 to 9 year
Right.
vehicle, and very different to the growth fund and complementary, because it's all about income and total return, not just total return.
Right. Right.
Oh, so income and capital growth, not just total return, which is what our growth funds to date have been about.
Yeah.
And then the other thing we learn, or my colleagues learn from historically, we used to do residential in our earlier growth funds,
Yeah.
and mixing residential with commercial is not the right thing to do. And we ended up in the earlier funds extending one of them because of the residential, and realised actually there was a far better opportunity to have a separate residential entity,
Yeah.
but doing smaller schemes, so raising lower sums of equity, doing smaller bespoke SME schemes, and I'm sure we'll come on to that.
Yeah.
And so we created what we call the Barwood Residential Investment Platform, otherwise known as BRIP,
Yeah.
and that's been going since September 2018.
Right. And so, yeah, so that's an interesting kind of segue again. Just to kind of to level set, what's in kind of broad percentage terms would be a split between, say, residential focus, industrial, et cetera, in terms of,
I mean, our split between commercial and residential is going to be 70-30
okay, in favor of commercial?
of commercial.
Yeah.
Yeah.
Okay.
I mean, we've got more vehicles on the commercial side
Yeah.
than on the residential, and
Yeah.
we've raised far more equity for the commercial piece than the
Right.
residential.
Yeah.
So yes, we're more weighted to the commercial, and within the commercial, our biggest weighting is to the industrial sector.
Right.
I
Right.
mean, our DNA is industrial and residential.
Yeah.
We've obviously created the separate residential piece, and then in the commercial side, industrial is definitely our biggest sector.
Yeah.
We have gone into other sectors. So we did some offices in some of the earlier growth funds, then probably didn't go into the office sector for about 5 years, until a few years back when we did our first office repositioning play in about 5 years,
Right.
3 years ago in Richmond, southwest London, in Growth
Right.
Fund 4.
Right.
We also own part of a business called Perseus, which
Right.
specializes in care home land planning and development plays.
Yeah.
And our growth funds 3, 4, and 5 have backed a number of schemes that Perseus have sourced and acquired.
Right. Okay.
So we've also gone into that sector of the market, and then most recently, our recent acquisition in our Growth Fund 5 is a student housing development
Right.
in Birmingham.
Yeah.
So
Right.
I would describe our growth funds to date as sector agnostic, but with a bias to industrial.
Yeah. Yeah.
And
Interesting.
sorry, we've not done any retail, as you've probably guessed.
Yeah.
In
Yeah.
fact, I haven't really spoken about that sector of the
You had
market.
you had enough of that from your earlier days, it sounds like. Yeah.
Well, I think they when I joined, they'd never done any retail, so
Yeah.
why start now?
Yeah. And just so I understand kind of let's say the life cycle. So are you getting engaged in an opportunity at the almost the zoning or the planning stage, through development, through stabilization, and then sell, or
Yeah,
yeah.
in some circumstances, it's as early as that.
Yeah.
And we've done that in the likes of industrial and the care home planning
Yeah.
plays, because that's in the name.
Yeah.
Um, but we also can get involved in schemes that have already got consent. So we've recently, for example, just bought an industrial site in Bracknell, which
Right.
already had consent, but we think we can do a better scheme. So we'll
Okay.
go into an amended consent, which is obviously a much simpler
Yep.
process.
Yep.
Because planning is a bit of a black hole, and I'm sure I think you
Yep.
might ask me about that in due
Mm-hmm.
course.
Yep.
So there the site is almost ready to go, subject to just getting an amendment to the planning. It's a cleared
Right.
site ready to go. The office building we bought in Richmond was an existing office building that had been owned by an institution. It was vacant. We saw an opportunity to buy it at what I felt was a very, very good discounted price.
Yep.
And we stripped that right back to frame, reclad it, and added a floor. And we've thrown all the bells and whistles,
Yep.
as we call it in the UK, at it, and it's BREEAM outstanding. It's EPCA plus,
Yeah.
WADS or gold, etc., etc.
Yeah. And a
So
lovely
that we
part
can
of
attract the
London.
best tenants.
Yeah. I spent much like yourself. I used to live in Chiswick, so I
Okay.
spent many a day by the river in Richmond. Beautiful part of the country. So if you look at just to kind of drill down on a couple of those sectors, and maybe
Yeah.
we'll move on to the kind of BRIP initiative after that. In terms of what's driving absorption of industrial, just take it kind of sector by sector. Like what are you focused on particular types of tenants or in that space, or focused on healthcare or logistics, or what does that look like for you? What's the
Yeah.
thesis?
We on the industrial side will range from a large logistics unit of
Hmm.
400,000 square feet.
Yeah.
So, for example, we developed a 360,000 square foot distribution warehouse up in Nottingham,
Hmm.
through to an asset management play up in Liverpool, where we bought an existing industrial unit with a tenant that was off a low rent. We saw that there was a really good lease, either a lease re-gear opportunity or at expiry, because it was a short-term lease, they'd
Yeah.
leave, we could refurbish and go for even higher rent.
Yeah.
Through to the multi-let industrial, where
Right.
that's all about how do you move the rental tone on, and you do that through lease events, through buying hopefully a bit of vacancy when you buy the estate.
Right.
You have targeted capex initiatives. You relet that vacant unit at a higher rent than the other units are let at, and you start to move the rental tone on. And the great
Yeah.
thing in multi-let is you only need to move it by 25 pence. And
Yeah.
the other fascinating thing with the multi-let is the occupiers you get, and they have changed enormously over my career. I mean, when I first looked at multi-let, you only went there in the daytime. You went quickly around the estate and you left quite
Yeah.
quickly because
Right.
it wasn't the best of tenants.
Yeah.
Whereas now we have estates where you have coffee houses on there, you have engineers, architects, it film studios. It's changed dramatically.
Yeah.
But the other fascinating thing with multi-let is the occupier is more concerned about what is my total per annum cost. Can I
Right.
afford it? Yes, I can. I'll pay it.
Right.
It's only us property people who go, well, what's that in pounds per square foot? Right. What are they paying in pounds? How can
Yeah.
we move the rents
Yeah.
on? Whereas when you get into the bigger mid-box, anything over 180 to 100,000 square feet, up to
Right.
the big box, which starts at sort of 250,
Yeah.
you're dealing with much more institutional style occupiers, whether it's a DPD, an Amazon,
Yeah.
a Puma, etc. And they will have in-house property teams who will understand about rent per square foot, service charge, and so look at
Yeah.
that in much more detail than the
Right.
multi-let.
Yeah.
So it's a fascinating sector. And if I go back through my career, it was probably regarded back in the early 90s as the lowest of the low. Offices was the
Right.
sector to be in. Then it was retail, and then what they used to call shed shifters,
Right.
guys who did industrial.
Empty warehouses.
That
Yeah.
started to pick up, and then it absolutely accelerated in
Yeah.
COVID. I mean,
Right. Of
just
course.
went,
Stratospheric. Yeah.
stratospheric.
Yeah.
And it just changed the whole dynamics of that sector. And we see it changing again with what we're calling the fourth industrial revolution, where with AI, with power, people,
Yep.
infrastructure. Um, and we believe at Barwood that the industrial market is going to move away from just being focused around motorway interchanges or what we call the golden triangle of the Midlands,
Yep.
or up in the northwest at Manchester, Liverpool, but
Yep.
go much wider in the UK on the basis of infrastructure, power, and people.
Right.
And so we think there's a real opportunity as that market evolves and expands into this next era going
And what
forward.
what does that look like, Hugh? I mean, as in less concentrated, more distributed.
Yes,
Yeah. Okay.
yes, less
Yeah.
concentrated, more distributed. And am I in a location where I can employ easily?
Yeah.
Because there are certain locations in the Golden Triangle where it's impossible to get hold of staff,
Yeah.
for example, or the rate they want is just too high
Right.
to
And
make it
the
work.
the technical drivers, and you mentioned AI, and I guess even some of the structural changes that happened in markets like retail as a result of COVID, and the significant online shifts that happened as a result of that,
Yeah,
are kind of demand predictions for logistics companies or for retailers becoming more efficient. That it's
absolutely. There's just
right.
been one of the biggest occupational deals in the market in a long
Mhm.
time with Marks and Spencer, one of our big
Right.
retailers.
Yep.
They've taken a 1.3 million square foot unit or to be built
Yep.
bespoke for them up at Durft in Daventry.
Right. Okay.
Um,
Yep.
and that is all about the fact that it's going to be BREEAM outstanding, it's going to be EPCA plus, it's going to be electrified, etc., etc.
Yeah.
And that's absolutely sustainability on that front, and future proofing is
Hmm.
is is becoming key.
Yeah.
Um, and we're probably seeing it more from the occupiers at the moment than from necessarily the investors.
Right. Yeah.
Um, and so, if you take our office building, for example, in Richmond, we knew that if we wanted to bring people back to the office following COVID,
Yep.
and we wanted to get the best rent, we wanted to get the best tenants, we had to create the best building. And
Yeah.
we believe, obviously, we would do that. We've created the best building in Southwest London.
Yeah. Yeah.
And you know, um, that efficiency, the amenities are just now so important to the occupier,
Yeah.
and that'll be
Yeah.
the same across all sectors.
I was going to say, I think that's we're seeing that certainly in the US. Just the focus on actually the kind of race to quality, if you will, in many respects, in terms of A grade. Not just that, but also the TIs that are showing up in in the type of deals that are actually gaining traction. Really, some significant shifts there. Just shifting gears quickly to the residential side of your business, then, Hugh. Could you characterize for people who are unfamiliar with the UK market on the residential side? Obviously, stateside actually shares a lot of similarities to large swathes of Europe insofar as the number of housing starts is down, absorption is
Yep.
high, major shift to the rental model, multifamily or multifamily. There's a lot of opportunity there. How does the UK look against a similar backdrop?
Yeah, no, absolutely. There is a shift. But 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 stepping back, high level,
Hmm.
there is a lack of housing
Right.
in the UK, and you'll have seen whether it was the previous government, then the Conservatives, and now the current governments. We
Yeah.
are way behind on supply of housing, both private and affordable
Right.
across the UK. And until the UK sorts out its planning system, I can't see how that is gonna, you know,
And
we're
what are
gonna
the
get there.
challenges there, Hugh? You mentioned that it's a major issue for.
Planning, whether you're in residential or
Yeah.
commercial, is one of our biggest issues
Right.
in the UK, and has not been helped by COVID, where staff in these local authorities who are under pressure have reduced their staff, don't do a full day week. And
Right.
so simple planning opportunities can take you twice, three times as long as you
Wow. Okay.
and but it's so inconsistent.
Right.
So if you take a scheme we've got, the office scheme we did in Richmond, central Richmond,
Yep.
residential next door, I thought 12 months to get planning is, if we did it slightly better than that, fantastic.
Right.
We got it in 4.5 by delegated powers.
Wow.
Wow,
Yeah.
brilliant.
Yeah.
We then buy a scheme, an industrial scheme in an industrial zone, a zone for employment, industrial round it, 2 years.
Oh my God. Okay.
Correct. So
Okay.
just
Yeah.
different people to deal with. The individual on that one, the individual in the planning department only worked 1 day a week.
Wow.
So yeah,
Yeah. Okay. Is
so I
that
would
is
say
that
that is our biggest issue. But no, so
yeah.
as I said, we've done residential in our growth fund, early growth funds,
Mhm.
but because of the size of the growth funds and the equity checks, we were doing quite large schemes of 50 to 150 houses.
Yeah.
And as we know with residential, all the profits in the last sale.
Yep.
And when you get into the much bigger schemes, you're competing with your Red Rose, your Wimpys, etc.
Right.
And then equally, we were finding it was just taking far longer than we anticipated to exit the
Right.
whole
Okay.
development. And we saw a niche in the smaller, 2 units to 20 unit scheme max.
Yeah.
We also saw a really good opportunity for our high net worth base to offer an entry ticket into that sector of the market at a very low barrier.
Yeah. In a
So,
well
so
understood kind of
if
asset
you want to
class. Yep.
invest in our
Yep.
residential platform, when we launch what we call a mini fund,
Yep.
it's £100,000 entry ticket.
Right. Yeah.
You won't
So
find
very
that in many fund investment management houses
yeah.
that go that low in terms of their entry
The
ticket.
minimums.
Yeah,
So
and we
very
tend to
accessible.
raise. Sorry,
Yeah. No, so you're targeting high net worth individuals.
it is really
That's
for the private investor base,
yeah.
and we've got a
Mhm.
whole range from what I call mums and dads.
Yep.
I'm an investor in a lot of our little mini funds
Yep.
personally, through to some very high net worth wealthy
Yep.
investors. And basically, the principle is we raise 3 to 5 million each time.
Yep.
We go and back 3 to 5 schemes to
Right.
create diversification of both risk, development risk, and locational risk and developer risk.
In a
Um,
partnership
um,
model, Hugh, are you
yeah, so
partnering with? Yeah.
we'll
Okay.
back a local SME house builder developer,
Right.
um, and we'll provide all the equity. We'll organise all the debt. We'll only buy schemes that have got planning because we want to be on the ground
Yep.
straight away.
Yep.
And the target is to be in and out of each mini fund in 3 years. And again, we had a number of our slightly elderly private investors who'd been the backbone of our commercial vehicles
Right.
going, love what you're doing there, but 5 to 7 years is quite long. I'm now
Yep.
75, 80 years old. Have you got anything shorter? So that was
Shorter
again
term.
another
Yep.
opportunity to offer them something shorter term.
Yep.
And it's equity multiple driven.
Right.
So that's the target. So we target a 1.3, or originally when we started it was 1.25. Now
Yep.
it's a 1.3 times money
Yeah.
over
Great.
3 years.
Yeah.
We are currently on fund 12, and have raised just over 50 million since we launched the whole product back in
Yeah.
September 18.
Yeah. Beautiful. And your, I mean, that kind of democratization of private capital opportunities, something that we're seeing more of, stateside, becoming more popular in the UK as
Yeah.
a concept. Yep.
Yes, and they're actually, so in our multi-let industrial vehicle, where we've raised 35 million,
Hmm.
as I say, we bought 8 assets, created a portfolio of 65 odd million.
Yeah.
We've had a number, but the entry ticket there was a minimum of 4 million.
Right. Yep.
And we had a number of our private investors going, oh, we see what you're doing in the multi-let industrial. We really like that income and capital
Yeah.
growth play.
How can we
So we
access it?
created a feeder vehicle
Right.
where we
Okay.
dropped the entry ticket down to 200,000,
Yeah.
and we've raised 6 million to date into that feeder, which then allowed us to buy more assets. And the three bigger investors were more than happy because it's allowing us to scale the
Yeah.
portfolio, and the multi-let vehicle is all about portfolio aggregation play, scale it to a size to create as much liquidity as possible for when you come to exit.
Yeah. And Hugh, what's the the RIA, Registered Investment Advisory Networks, very active in the U.S. Are you working with financial advisory firms? Do you have introductory
No, we
models? No,
tend to,
you're de-
it's
you're
quite
dealing
tough over
direct.
here. It's quite tough over here because they like to be selling their product, not
Yeah.
someone else's.
Right.
Where we've had some interest is talking to some of the larger wealth managers,
Yeah.
like a Barclays Wealth or a Coutts or a
Yeah.
Saranac,
Right.
more that way. But actually, most of it we do through social media.
Right.
We host a breakfast seminar every quarter in London and
Right.
invite people to come and meet the team, hear all about it. The great thing with our residential platform is you register on it, but with no, you do not have to invest, and you can
Right.
pick and choose which fund. So, for example, I invested in number 1, and then in number 4, 5, 8, and 11.
Right. Yeah. So you
So you
can.
can, but by being a registered investor on our platform, you then get to see all our product offer.
Yeah. Great.
So again, I think that makes Barwood unique to others
It is.
in the
Yeah.
UK
It's
market.
yeah. It is pretty unique. Um, do you find? I mean, is it challenging dealing with the, let's say, the lower ticket value investors, retail investor, kind of end of the market, as it would be referred
You
to?
know,
And
it's very different. So Rockspring is the
yeah.
easy way to describe it. Rockspring. All our investors were large institutions from around the globe, probably putting in a minimum of 25 million each time. And I might have met them once a year if I was lucky. Sometimes it was every other year.
Yeah.
With the non-institutional investor base, I might go and, particularly the slightly larger ones, I'll go and have a cup of tea with them
Yeah.
one
Yeah.
afternoon, and you get to know them personally,
Yeah.
and that's why, in fact, I'm a strong believer in those relationships you create, and Barwood have been very, very good at that, and that's why we have an 80% repeat investor rate.
Yeah. Yeah, no,
Um,
that's great. I mean, it is a trend that we're seeing across the board, and even the large, the tier one
yeah,
firms launching retail focused funds, with 50K tickets minimums. So
yeah, yeah.
yeah,
I was on the phone this morning to an investor who's in our multi-let feeder,
yeah,
who'd put £200,000 in and just wanted to have an update.
yeah,
Yeah.
yeah, yeah.
And whereas I'll get on the phone tomorrow to talk to Merseyside Pension Fund,
Right.
who I probably
Yeah,
haven't spoken to for 2 or 3 months. So
yeah,
then,
yeah,
yeah. So it's it's been an eye opener for me going from a very institutional only to having
yeah.
the boat, and I love it. I love that.
I mean, I think it makes it very real, and
Yes,
you kind of connect with the. I mean, in many cases, for the individual, the ambitions that they have for their family or for the college fund for their kids or whoever it is that's
school
motivating the
fees. Yeah,
investment. Yeah,
exactly. Yeah,
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 makes it
yeah,
very real.
yeah.
And that's the business we're in collectively, is kind of putting some structure, some rails around that, as much predictability as you can, and obviously risk
No,
adjusted
absolutely,
opportunities.
absolutely. Yeah,
Um, just as we kind of look towards the future, then Hugh, I mean, you mentioned a couple of things that you can see at a macro level. There are strong trends towards that kind of decentralized approach on the industrial or logistics related initiatives. Are there any other areas, as you look at, let's say, over the next 5 years or so, that are exciting to you, that are emerging opportunities that are potentially showing, some legs that, whether they're proven out or they're just showing early
yeah,
interest.
yeah. No, I like the self storage sector.
Yeah.
Um, because I think one of the things over my career with real estate is it's becoming more and more operational,
Hmm.
and so I like things like self-storage. I'm interested in the life sciences,
Right. Yeah.
but at small scale, not trying to build the big
Yeah.
blocks that we're
Right.
hearing a few ums and ahs about at the moment with
Right.
AstraZeneca saying what they've just said, and Merck. A
Right.
few people are getting a bit nervous who've built very big life science schemes. We,
Yeah.
for example, bought a little scheme of 4 units just south of Cambridge last year, which to you and I, if I showed you an aerial view, you go, "Oh, that's a nice multi-let industrial estate."
Right.
But 2 of the units are converted to lab space,
Right. Okay.
and
Yeah.
we're gonna convert the other 2. And, as multi-let industrial, rents are 14, 15 quid pounds a foot.
Yeah.
As lab space, you're early to mid-40s.
Right. Right.
So
Yeah.
again, exciting opportunity.
Yeah.
Now, there's risk with that, because you're 9 times out of 10, your tenant's gonna be a starter
Yeah.
and is either gonna find the gold, the
Yeah.
golden nugget, and then the next thing you know, they've been
Right.
bought and they quadrupled in value and moved to one of the big science parks,
Yeah.
or they're never gonna find the golden nugget and
Crash and
they go into
burn.
administration.
Yeah.
But
Yeah.
but if you've only got a 6 or 5 or 6, 7,000 square foot unit, and if worst comes to worst, you just relet it as multi-let industrial.
Yeah.
So
Yeah. It's an
I I I
interesting
I I like
edge. Yeah.
I like that. Um,
Yeah.
I mean, interestingly, to really answer your question, as I said, we're about to launch Fund 6.
Yeah.
It is going to be 100% industrial.
Yeah. Yeah.
I'm not gonna look at any other sector. I mean, it'll have subsectors like the lab type play I spoke about,
Yeah.
self-storage,
Yeah.
but it's gonna be 100% industrial in
At the core.
its focus. Yeah.
Yeah. Yeah. Very
Because that's
good.
where we A, it's our DNA, and it's B, it's where we see the future value and growth over the next 5 years.
Yeah. Yeah, no, that's great. It's great to hear, and I guess that 5 year hiatus that you had away from the office, or rather, Barwood had away from the office focus, has probably turned out to be quite a good,
Yes.
for you. I know, I appreciate there are opportunities now, slightly differentiated opportunities, but yeah, it is. It's fascinating to see uh, just the access that's being made available to. I mean, I know traditionally as you look to the retail sector, ultra high net worth, then to high net worth, and then, just to people who've got that, some savings that they can put to work here, and take advantage of the private
Yeah.
markets in a way that they haven't before is very exciting. You guys are leading the charge. It seems, in the UK market.
I hope so, and because a lot of it is about how can we make the barriers to entry more easy for them.
Yeah, yeah, abs-
Um, and that, if we can do that, because you then get a very loyal investor base.
yeah, yeah,
And some of our investors have been with us since 2009.
yeah. No,
Um,
that's great.
yeah,
Yeah, fascinating history with Barwood, but it sounds like some of the best years are ahead of you, which is always
I hope
good.
so. I hope so. I
Yeah,
mean, we've had, we've from a UK market perspective, the whole thing turned on its head back in June 2022, and you had interest rates going through the roof, inflation was up,
yeah,
and then we had Liz Truss. That didn't help.
right.
The market probably hit rock bottom in 2024.
Yeah,
Um, it actually picked up in Q4 2024, and
right.
I personally then got quite excited about the beginning of this year,
Yeah,
and then we obviously had the Trump tariffs, which
yes,
put everything back into uncertainty. And then since then, you've had the wars getting worse in Ukraine or in Gaza, which has
yeah,
created more uncertainty. Then all the issues with our current government and
hmm,
what's going on there,
yeah,
and then totally unhelped by the budget being pushed back by another month to the end of November.
right.
We saw today interest rates have been kept at 4. I personally think they're going to stay at that until the new year,
Right.
and therefore I think we're going to see a market that's not confident enough to come back, certainly this year.
Yeah,
Having said that, if you've got capital to invest, there will be opportunities. It's
yeah,
just finding the right opportunity and the willing seller.
Yeah, I mean, it's impossible to kind of predict the bottom of the trough, but certainly, uh, um, I'm hearing, and we see it in our client base. Fundraising is definitely on the uptick again. There's
Yes.
cautious optimism, I would say, kind of green shoots of recovery, but nobody kind of running away with themselves in terms of using too many adjectives to describe what's happening. I think people are just
Yeah,
uh,
we're not seeing any yield compression, Freddie.
yeah, right.
Yields are pretty much plateauing at the moment.
Yeah.
What is where I'm positive is we're still seeing rental growth.
Yep.
And jumping back to our Fund 6, whilst it's going to be 100%, it's going to be much more income focused than total return focused.
Right. Right.
Because we see a real opportunity in buying income, and with
Yep.
targeted capex and proactive asset management really
Yeah.
growing that income, and that's underpinned by the rental growth that we're still seeing. Whereas, yields at the moment, with bond yields having jumped to 4.75 last
Mhm.
month, earlier this month, like the other week,
Yeah.
that gap, that all risk gap, is now at 150 basis points, which is at
Yeah.
the cusp.
Yeah.
But if you read everything, it looks like it is going to start widening as we head into 2026, and
Yeah.
that hopefully, I mean, the bit we're missing right now is confidence. We
Yes.
just need confidence back in the market.
Yeah.
Um,
Yeah.
but if you're investing in real estate, you're investing for mid-long term. You're not
Yep.
investing for quick turnaround. And my humble view is it's only going to get more expensive over the, it's just not going to happen like previous cycle. If you take GFC, it came back quite quickly.
Right.
This is going to be a much more slower, steadier. But we're seeing lending getting better.
Right.
And if interest rates do drop during 2026 to the 3.5, possibly some houses are saying a bit lower than that, but even at 3.5,
Yeah.
you,
It's gonna
you
help
could get a good
to.
stabilized market. So
Yeah.
that's why I'm really excited about Fund 6, because now's the moment to have the war chest to then start to buy.
Yeah. Yeah. Absolutely. Well, exciting times, Hugh, and
Thank you.
great to understand the history of the company, your personal history as well. For anybody who wants to learn more about Barwood, and indeed connect with yourself or your team, what's the best way to do that?
On social media, through LinkedIn, through our
Yep.
website. We have a lovely lady who runs all that, called Hayley
Okay.
Gorge.
Yep.
And I mean, that's the great thing about, we're a team of 22.
Yep.
Everyone gets their sleeves rolled up. And as I said, constantly say to investors and others, they can talk to me one day, or they can talk to the office manager the next, or the asset manager, or
Yep.
my CFO. We're all there as
Yeah.
and when we're wanted.
Yeah. Perfect. Well, we'll put the link to your website and to your LinkedIn in the show notes here, for anybody who wants to connect with you or the team. But
Yeah.
for today, Hugh, thanks very much for joining us on the podcast.
Well, thank you very
Um,
much for having me.
yeah, and continued success here as you look at Fund 6 and beyond.
Thank you. Thank you. And
Thanks a lot, Hugh.
thank you for having me.
Take care.
Many thanks. Bye bye.